Warren Buffett is renowned for his timeless advice. Price is what you pay, value is what you get. This quote has become a cornerstone of value investing, guiding countless investors in their pursuit of undervalued assets. Its simplicity and clarity have made it a mantra in the financial world, shaping investment strategies for decades. Yet, beneath its surface lies a provocative question. Could this celebrated wisdom actually mislead most investors? As we explore the true meaning and implications of Buffett's words, we'll consider whether following this guidance without deeper understanding might become a trap rather than a pathway to success. Expert investors often thrive by taking calculated risks and leveraging sophisticated strategies. What works best for them, such as aggressive trading or complex financial instruments, can seem enticing to amateurs. However, these same tactics can quickly become dangerous traps for those without deep experience or knowledge. The allure of high returns may overshadow the hidden pitfalls, leading novices into costly mistakes. This paradox raises an important question. Why does the best thing for seasoned professionals often spell trouble for beginners? To understand this, we need to look beyond surface-level advice and uncover the true meaning behind the quote. Think back to a time when you purchased shares in a company you believed was truly great, but was facing a period of temporary trouble. How did you feel about your decision at the time? And what were your expectations for the company's recovery? Many investors are drawn to these situations, hoping to capitalize on a rebound. However, it's important to recognize that this approach comes with its own set of challenges. Common pitfalls include misjudging the severity of the company's issues, overestimating the speed of recovery, and failing to account for broader market factors. By reflecting on your own experiences, you can better understand the risks involved and avoid repeating costly mistakes. The phrase, "buy the dip," has become a rallying cry among investors, especially when well-known companies experience a sudden drop in their stock price following negative news. Many interpret this approach as a sound strategy, believing that temporary setbacks offer opportunities to purchase shares at a discount before prices inevitably rebound. This interpretation often draws on popular financial quotes and advice, suggesting that patience and optimism will be rewarded. However, the myth persists that all dips are created equal, and that every decline is a buying opportunity. In reality, not every downturn leads to a swift recovery, and some companies may face long-term challenges that prevent them from regaining their previous value. Understanding the context behind the quote and the specific circumstances of each company is crucial before making investment decisions based solely on market dips. When stock prices begin to drop, many investors are quick to take notice, especially if the companies involved are well-known brands. The familiar logos and household names can create a sense of trust, leading some to believe that any dip in price is a rare chance to buy in. However, this reaction often overlooks the underlying reasons for the decline. Volatility can be caused by market uncertainty, shifts in consumer behavior, or broader economic challenges. Mistaking short-term fluctuations for genuine investment opportunities can result in hasty decisions. Without careful analysis, investors may find themselves exposed to greater risk, simply because a recognizable brand appears temporarily undervalued. This approach is often mistaken for investing, but in reality, it resembles reactionary gambling. Instead of relying on careful research or thoughtful analysis, decisions are made impulsively, often based on market hype or fleeting trends. True investing involves evaluating fundamentals, understanding long-term prospects, and making informed choices. In contrast, reactionary gambling is driven by emotion and speculation with little regard for underlying value. This lack of real analysis exposes individuals to unnecessary risk and unpredictable outcomes. Ultimately, without a solid foundation of research, Such strategies rarely lead to sustainable financial growth. One of the most common pitfalls in investing is mistaking a falling stock price for a true bargain. It's easy to assume that a company facing difficulties is simply experiencing a temporary setback and that its shares are undervalued as a result. However, not all declines signal opportunity. Sometimes, a dropping stock reflects deeper, more persistent problems within the business itself. Investors who overlook these warning signs risk buying into companies whose struggles may not be short-lived. Recognizing the difference between a genuinely undervalued business and one in decline is essential to making sound investment decisions. Throughout history, several companies have faced what appeared to be temporary setbacks, only for these issues to mark the onset of lasting decline. Kodak, once a leader in photography, dismissed the rise of digital cameras as a passing trend, but this misjudgment led to its eventual bankruptcy. Blockbuster, too, underestimated the impact of streaming services, believing its rental model would recover. Yet, it never regained its former dominance. Nokia, once the world's largest mobile phone manufacturer, struggled to adapt to the smartphone revolution, and its market share rapidly eroded. These examples highlight how temporary trouble can sometimes signal deeper, irreversible challenges, emphasizing the importance of recognizing and responding to fundamental shifts in the business landscape. As we shift our focus, it's important to recognize a subtle yet significant difference in perspective. Warren Buffett often uses terms like great and temporary in ways that may not align with the public's understanding. For Buffett, a great company is one that demonstrates enduring competitive advantages and consistent profitability, rather than simply being popular or well-known. Similarly, when he refers to setbacks as temporary, he evaluates them based on long-term fundamentals, not short-term market fluctuations. This distinction shapes how he makes investment decisions and assesses opportunities. Understanding these nuances can offer deeper insight into Buffett's approach and why it sometimes diverges from conventional wisdom. Warren Buffett defines a great company as one possessing durable competitive advantages that allow it to maintain its market position over time. These advantages might include strong brand recognition, cost leadership, or unique products and services that are difficult for competitors to replicate. For Buffett, long-term predictability is equally important. He seeks businesses with earnings and growth that can be reasonably forecasted far into the future. This predictability often stems from stable demand, consistent management, and a clear business model. In essence, a great company is not just successful today, but is also likely to remain resilient and profitable for decades to come. Buffett's approach emphasizes patience and a deep understanding of what makes a business sustainably superior. When most people think of a great company, they often focus on its popularity or impressive track record. High sales figures, widespread brand recognition, and past successes tend to shape public perception. However, Warren Buffett evaluates greatness differently. He prioritizes a company's resilience, the ability to withstand economic downturns, and competitive pressures. Central to his approach is the concept of a moat, which refers to a firm's durable competitive advantage that protects it from rivals. While public opinion may be swayed by short-term trends, Buffett looks for businesses that can sustain their success over the long term, regardless of market fluctuations. When Warren Buffett refers to temporary trouble, he is describing challenges that are external and short-lived, rather than deep-rooted problems within a company. These issues might include market fluctuations, regulatory changes, or economic downturns that affect performance for a limited time. Crucially, Buffett distinguishes these setbacks from fatal flaws, emphasizing that they do not compromise the company's core strengths or long-term prospects. He believes that as long as the business fundamentals remain intact, such as strong management, competitive advantages, and sound financials, the company can recover. This perspective allows him to invest confidently during periods of uncertainty, trusting that resilience and quality will ultimately prevail. The American Express Salad Oil Scandal of 1963 serves as a compelling example of how temporary trouble can be mistaken for permanent damage. In this case, American Express became embroiled in a massive fraud when it was discovered that its warehouse receipts for salad oil were largely backed by non-existent inventory. The resulting financial losses caused a sharp decline in the company's stock price and widespread concern among investors. However, upon closer examination, analysts recognized that the scandal, while damaging in the short term, did not undermine the core business or long-term prospects of American Express. The company's reputation and operations remained fundamentally sound, allowing it to recover and eventually thrive. This case highlights the importance of differentiating between setbacks that are temporary and those that signal lasting harm, especially when making investment decisions. Applying Warren Buffett's wisdom at an expert level demands more than just familiarity with his principles. It requires rigorous analysis of financial statements, business models, and market trends to uncover genuine value. Experience plays a crucial role, as seasoned investors develop intuition for identifying patterns and assessing risks. The ability to distinguish real opportunities from potential traps is essential, often involving skepticism toward hype and a disciplined approach to decision-making. Mastery in this area means knowing when to act and when to wait. Guided by both analytical skill and practical judgment, the central enigma lies in the deceptive nature of the quote, which exemplifies survivorship bias. This bias occurs when we focus only on the success stories, ignoring the countless failures that never make headlines. The advice embedded in the quote may seem compelling, but it overlooks the reality that most investors do not have the same resources, information, or circumstances as those who succeeded. As a result, following this guidance can lead to unrealistic expectations and risky decisions. The quote is not universally actionable because it fails to account for the broader context and the many variables that influence investment outcomes. By recognizing survivorship bias, investors can avoid the trap of believing that replicating a winner's strategy guarantees similar success. Feeling like an insider in the world of investing can be deceptively reassuring. This sense of belonging may lead individuals to overestimate their knowledge or underestimate the complexities of financial markets. When uncertainty arises, the temptation to gamble against seasoned Wall Street professionals becomes especially risky. These experts often have access to advanced tools, vast resources, and years of experience, giving them a significant advantage. Individual investors, on the other hand, may be influenced by emotion or incomplete information, increasing their vulnerability to costly mistakes. Overconfidence can result in substantial financial losses, particularly when market conditions are volatile. It is important to recognize these dangers and approach investing with caution and humility. A prudent approach to investing emphasizes selecting decent companies at fair prices rather than chasing speculative trends. By focusing on businesses with solid fundamentals, investors can build a portfolio that stands the test of time. Diversified index funds offer broad market exposure, helping to reduce risk while capturing overall growth. Systematic investing, such as regular contributions over time, allows individuals to benefit from market fluctuations and compound returns. This disciplined strategy prioritizes long-term security and financial stability, making it a reliable choice for those seeking sustainable wealth accumulation. True safety and peace of mind are not found in chasing dramatic opportunities or quick fixes. Instead, they come from careful preparation and a thoughtful process. By focusing on building solid foundations and following proven steps, we can avoid unnecessary risks and uncertainty. Preparation allows us to anticipate challenges and respond with confidence, rather than reacting impulsively to fleeting chances. When we prioritize process over excitement, we create a stable environment where genuine security can flourish. Ultimately, it is this steady approach that leads to lasting peace and well-being. Everyone has their own approach to investing, shaped by personal experiences and goals. Sharing your unique rules for safety and peace of mind can help others learn and refine their strategies. By contributing your insights, you become part of a supportive community where ideas and best practices are exchanged. Open discussion not only fosters learning, but also builds confidence in making informed decisions. Together, we can create an environment where investing feels less daunting and more collaborative. We're always looking for new ideas to explore and discuss. If you have a favorite investing quote that you think deserves a closer look, feel free to nominate it for future analysis. Your suggestions help us uncover the wisdom and sometimes the misconceptions behind popular financial advice. Whether it's a classic saying or a modern catchphrase, we welcome your input. Share the quotes that have influenced your thinking or sparked debate. Together, we can critically examine the guidance that shapes investment decisions. As we wrap up, it's important to remember the value of staying vigilant and informed. The lessons from this investigation highlight the significance of careful decision-making and awareness in our daily lives. By applying these insights, we can better protect ourselves and those around us. Prudence and caution remain essential tools for navigating uncertainty. Let these key takeaways guide your actions, ensuring safety and confidence in whatever challenges you face.